It's been a while since we've spoken about Enphase Energy, and with the company reporting its quarterly figures on Tuesday, October 22nd, I thought it would be a great time to revisit that company and that stock. Now, Enphase is down 30% year to date. Over the last 3 years, the stock is down 47%, and over the last 5 years, the stock is up over 265%. It currently has a market cap of $12.41 billion and a forward PE of 24.5 times. Now, currently, if we look at what the analysts are expecting for fiscal 2024, well, a horrible year, right? Sales expected to be down close to 39% year over year, and EPS closer to 43%. But then the analysts are expecting a reacceleration in fiscal 25 and fiscal 26 top and bottom lines. If we look at the current average analyst price target, and here we have 40 analysts covering this stock, it sits 35% higher than the price we're at today, but we have seen a couple of downgrades in the last couple of days. Looking at some pricing metrics here, so forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, we can see that the stock is cheaper than its 5-year mean across the board. Now, of course, previously this company was also growing much faster than it is today, so that's why it has gotten a higher premium previously. But then again, if you look at price earnings to growth, which is forward looking, it's 1.23, in my opinion, not that expensive. Now, we also know that interest rates are coming down. That definitely helps a company like Enphase. Now, Enphase does operate in a, I would say, highly competitive industry. I mean, you've got Chinese players, you've got players like Tesla as well, Powerwall 3, for example. So it's a pretty competitive space. They are a well-established name in that industry as well. Plus, free cash flow positive, profitable, growing. I mean, not that many companies in that industry can say the same. So before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So if we look at what the company reported 3 months ago, so in Q2, we can see that revenue has reaccelerated, right? Because revenue was coming down quarter after quarter after quarter. Still, year over year, it's down by quite a lot. I mean, Q2 2023, they generated over $711 million of revenue. Q2 of 2024, only $303.4 million. But of course, that's better than Q1. As for gross margin, that went up as well, 45.2%. If we look at operating income, that's back into positive territory. Net income, same thing there. Basic EPS and diluted EPS, 8 cents on a GAAP basis and 43 cents on a non-GAAP basis. Now here you basically get a better picture of what has happened, right? Revenue peaked back in 22-23. Free cash flow, same story there, although free cash flow did stay positive, and that's basically a strength of that company. Now the expectations is that, well, revenue will reaccelerate as we've seen, and free cash flow will accelerate as well. Now keep those numbers in mind here when we'll do the reverse DCF later down the line. If we look at gross profit margin, operating margin, net income, same story there. It peaked 2022, 2023, and then we went down, 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 and of course the stock followed. Then as for the revenue split, so you've got international and you've got US revenue. As you can see over the last couple of years, since Q4 2019, international revenue has increased by 610%, while US revenue has, well, now only increased 1.75%. But of course, back here, Q2 2022, Q1 2023, that's basically where those segments have peaked. Then if we look at the microinverters, how many of those they've shipped, that has peaked back here in Q2 of 2023. Last quarter, they shipped around 1.4 million of those compared to close to 5.2 million here in Q2 2023. Now looking at what the company expects to generate in Q3, so the numbers that we're going to get on Tuesday, they expect revenue to be between $370 to $410 million, which includes shipments of 160 to 180 megawatt hours of IQ batteries. GAAP gross margin to be within the range of 45 to 48% with net IRA benefit. Non-GAAP gross margin to be within the range of 47 to 50% with net IRA benefit and 39 to 42% including that net IRA benefit. Now, if we keep those numbers in mind, 370 to 410 million, we can then compare to what the analysts are expecting. So they are expecting revenue at around $393.58 million, EPS normalized estimate 78 cents, and on a GAAP basis 38 cents. If we look at the EPS revisions, we've had 8 revisions on the upside and 18 on the downside in the last 90 days. Now, for the next 9 to 10 years or so, the growth rates for EPS and revenue, it's expected to be at around 16-17% or so. Now, before looking at what the analysts have told us, I just want to show you again a comment that was made in the last earnings call. So this is the CEO basically talking a little bit about what they have been seeing already in Q3 and, well, in the last couple of months. So he says here, we did not guide Q4, but we are very optimistic based upon what we're seeing. We have successfully normalized our channel inventory by the end of Q2. Our customer demand increased by 5% in Q2 as compared to Q1. Our battery business is doing phenomenally well, 75.5 megawatt hours in Q1, 120 megawatt hours in Q2, midpoint of guidance 170 megawatt hours in Q3, and we naturally expect it to do well. Our Q3 bookings are the healthiest that we have been in a year. These are the early indicators for you. So pretty positive comments that were made 3 months ago. Of course, this was 3 months ago. Let's see if something drastically changed. Of course, we know that since then, interest rates have come down. So maybe that could change what we see in the report and especially the commentary for the coming quarters and exiting 2024 going into 2025. Talking a little bit about batteries specifically, they say here we don't usually break out the regions, but I will tell you we expect Europe is a little bit seasonal. So I think maybe a little down to flat in Europe, but the growth, a lot of the growth is coming from US and a lot of growth in California on batteries. Moving on to 2 analyst notes, one from RBC Capital. They cut the recommendation to sector perform from outperform with a $100 price target down from $125, citing competitive market dynamics that should result in a slower pace of growth next year, not yet reflected in consensus estimates. The high interest rate environment and ability of TPO systems to access High Inflation Reduction Act or IRA tax credit support continued TPO adoption, which could be an increasing headwind to demand growth next year. Battery demand has surprised to the upside year to date, but the analyst believes Enphase share gains could be more limited going forward, as sales are almost fully converted to the current gen battery and additional market share gains in California could be more challenging, especially if Tesla is successful in driving demand for the Powerwall 3. Moving on to the other analyst, here we got a downgrade at Susquehanna to neutral from positive with a $104 price target cut from $147, citing the slower than expected recovery in the United States, residential and market share concerns, coupled with the stock's premium valuation. I mean, I wouldn't really call it a premium valuation, but okay. The analyst said his recent conversations indicate project delays remain a headwind for utility-scale projects, with utility-focused names at risk of seeing further push-outs into 2025 as project cycle times expand, and election uncertainty also has weighed on some project sanctioning, particularly with smaller developers. The analyst says his concern for Enphase is that the increasingly competitive landscape could make it difficult for the company to maintain its superior market share and margin leadership in the inverted market, which could weigh on the stock's premium valuation. Again, I find it very, very strange that they're coming out with these types of comments just a week before the earnings report. I mean, why not wait a week, get the numbers, get the commentary from management, and then make the decision? This is just putting extra pressure on the stock, actually on a stock that has been coming down for quite a while now. I don't know, feels quite strange to me. All right, so if we look at Enphase right now, we plug in here the free cash flow in the trailing 12 months, which is $297 million. We know that that's going to increase quite fast in the coming years. Here's the terminal growth rate, the discount rate, and this is basically the implied growth rate. The implied growth rate to justify today's price is 9.5%. Now we've seen that it's expected to grow much faster than that. So currently the implied growth rate 9.5% for a company that, yes, it's true, there is some uncertainty around it, whether the recovery has started fully or whether it's a delayed recovery remains to be seen. But if we're looking purely from a risk rewards perspective, I don't think this is so bad, right? 9.5% implied growth rate for the next 10 years to justify today's price, stock price, knowing that free cash flow, well, not knowing, but seeing what the expectations are for free cash flow growth, for revenue growth in the coming years, I mean, 9.5 does not seem that much. But if we look at the graph, and this is not looking at the business, this is purely looking here at some candles, we know that this stock does not have any momentum with it right now. Actually, if we look at the last couple of months since February, it has failed to stay above the 200-day moving average and was actually rejected numerous times. Right now, we are a bit in no man's land here at $91.64. RSI is low, but far from being oversold. But yeah, you're a bit here in no man's land. To go back to the bottom here that we've seen back in November of 2023, the stock would have to drop another 15%. Now, it can happen if the numbers for the report are completely horrible and guidance as well. We've seen that happen before. But if not, if they beat Q3 guidance and if Q4 and maybe even some commentary on 2025 are better than expected, then I fully expect to see a big green candle here. Now, me personally, I have no position in Enphase, but I do think that this is a company that is quite healthy. It's operating in a market that is expected to grow for years and years to come. Yes, there is some uncertainty in the short run, for sure. But would you rather buy this company when it has peaked, right? When margin peaked, when revenue peaked, free cash flow peaked? Or would you rather pick up this company when, well, it's still profitable, still generating free cash flow, and is in a position to see accelerated growth in the coming quarters? Now, of course, with the earnings coming up, it's a bit of a gamble, can go up, can go down. So it's always the same answer for me. If you already have a position, I mean, why not wait a little bit, right? You won't really miss that much. And if you want to open a position, if you really want to have your position already, you can still open a tiny position right now. If it goes up, that position is up, you get more information, that's great. And if it comes down, you got more information, and then you can increase your position whenever you want. It will cost you less, of course, and so your average will come down. So that's all I've got for you for Enphase right now. We'll cover the company's earnings, of course, on Tuesday, so stay tuned for that. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.